The tech sell-off is back on. European shares are heading for a weekly loss after even Nvidia's blowout results didn't support market sentiment for long. There was more selling on Wall Street by Thursday afternoon. The slide is being driven by worries vast amounts of money being spent on the build-out of AI aren't being backed up by profits, and that some valuations in recent months have moved too high for comfort. Chris Rossbach is Chief Investment Officer at J.Stern. Chris, is the market losing faith that huge spending on AI is paying off?
We think we're just at the beginning of the need for computing capacity to increase productivity. We have seen that some of the very first adopters of AI, in particular the hyperscalers and the big platform companies, are making use of AI, of the GPUs they're buying from NVIDIA to significantly improve their businesses, to increase their revenues and their profitability. The one that's profited most is Facebook. So we think where data is available and where it can be used, there are use cases that are generating cash. And we think that those companies' demand explains the revenues for NVIDIA. And that's what they said in their guidance. So no, we don't think that there's a bubble. We think that the demand is well underpinned. But that's not saying that there's not overvalued companies and that some expectations aren't unrealistic.
Are there some elements in NVIDIA's results that should raise concerns, though? The concentration of its revenue in just a few customers. I think nearly 2/3 of that revenue came from just 4 companies. And then the deals with OpenAI and Anthropic, in which it's essentially investing in them, paying them to buy its chips.
I think both are good points, and they're in the results, but we don't think that either are a real concern for NVIDIA, for its business, or for its valuations. The first point on the concentration is what I just tried to address as well, which is to say that it's the big hyperscalers and the platforms that have the use cases that are putting the computing capacity in place that they need. And that's in part because companies like Amazon and Alphabet and also Microsoft actually have the large cloud computing businesses that are complements to that. And it's because the networking companies, in particular Meta, but also others, are using it to drive content, to drive engagement, to drive advertising, and to generate cash. So the concentration on that side, we're not worried about, and they highlighted that they have an entire ecosystem that they're building to increase the demand from companies that are developing new models and new use cases. So that's on that side. On the question of OpenAI, in aggregate, they've announced $1 trillion of demand for services and products, 400 to 500 billion from NVIDIA, 300 billion from Oracle. That may or may not happen, but it's not necessary to explain the revenues or the valuations from NVIDIA. And with Oracle, you've seen the market cap went up when that was announced. It is entirely retraced. It's hundreds of billions of dollars. So some people made money, some people lost money from investing in it, but it's neither systemic nor does it tell us anything about the underlying demand for AI. So we think investors really have to look at the fundamentals at the companies and not get distracted by the headlines.
When hyperscalers like Meta started to build out data centers at vast expense, though, they were using cash on hand. Increasingly, they're issuing debt to pay for it. Should that concern investors?
It's a different model, but these companies are highly cash generative. It's true for NVIDIA, but it's also true for the hyperscalers and platforms. And so the fact that they've been able to allocate that capital to growth, to OPEX, to CAPEX, and significantly to share buyback, including NVIDIA, to offset some of the dilution from options. So they have that cash generation. They've had very conservative balance sheets. They have not been that capital intensive. Now, Amazon being the exception, now that they are becoming somewhat more capital intensive, which is clearly the market's concern, it's actually right for them to be using the full set of options that they have in terms of their capital structure. And so for them, issuing debt is significantly cheaper than issuing equity for sure. There's no suggestion at all that they're going to be doing that. On the contrary, they're buying it back. But we think using debt to fund capital expenditure into this computing capacity is actually the right thing for them to do. So we don't think it's a concern. We think it's more a question of the state that these companies are in, and the fact that they're now moving in terms of their capital allocation to something that is more capital intensive than it's been in the past.
Some air, though, is clearly going out of these very high valuations that we've seen recently. Should the market be braced for a steeper drop in asset prices?
Again, I think you have to look at the fundamentals. We think that the companies that I've been talking about, the hyperscalers, the platforms, NVIDIA, and other businesses that are in producing either the actual GPUs or, in the case of, for example, an ASML, the technology in order to produce semiconductors, or that are having the actual services that are being enabled by the GPUs, are at reasonable valuations and in some cases cheap. So we don't think that those are the overvalued companies. There are others that are much more highly valued, so there will be volatility. But you've seen that in April of this year, how quickly that can move, how big those drops can be, but also how great they as opportunities they can be.
That was Rossbach of J.Stern. Don't forget you can watch more videos on Reuters.com.